Today, we're diving into the world's most overlooked investment opportunity, international government bonds. We're talking about sovereign debt from countries across the globe that have quietly delivered exceptional returns, while most investors focused on domestic markets. Intrigued? You should be. In 2024, the FTSE World Government Bond Index delivered a remarkable 8.28% return in yen terms, while emerging market local currency bonds soared with an impressive 13.8% year-to-date performance, significantly outpacing many traditional asset classes. To put that in perspective, these bonds consistently provided both yield and currency appreciation benefits that domestic investors completely missed. But here's the kicker: international government bonds aren't just about chasing higher yields. They're about accessing entirely different economic cycles, monetary policies, and currency opportunities. So how can something as seemingly conservative as foreign government debt generate such compelling returns? Stick around, because we're about to unpack how international government bonds work, which countries offer the best opportunities, and what made 2024 such an exceptional year for global bond investors. Let's start with the basics. An international government bond is debt issued by foreign sovereign nations, denominated either in their local currency or in major currencies like the US dollar. When you buy a German Bund, Japanese government bond, or Brazilian real denominated bond, you're lending money to that country's government in exchange for regular interest payments and principal repayment at maturity. It's like being a bank to entire nations, but with the added complexity of currency risk and reward. Imagine buying a 10-year German bond yielding 2.7%. You're not just earning that interest rate, you're also exposed to euro-dollar exchange rate movements. If the euro strengthens against the dollar during your holding period, you get both the bond return and the currency gain. Conversely, currency moves can work against you, but this two-way exposure creates opportunities that domestic bonds simply cannot offer. The international government bond universe spans from ultra-safe developed market debt to higher-yielding emerging market securities. German Bunds and Japanese government bonds represent the safest end of the spectrum, often yielding 1-3%. Emerging market bonds can offer yields of 6-10% or more, but with significantly higher currency and political risk. Why venture beyond domestic government bonds? 3 compelling reasons: diversification, yield enhancement, and currency exposure. International bonds behave differently from US Treasuries because they respond to different central bank policies, economic cycles, and political developments. When the Federal Reserve is tightening, the European Central Bank might be easing, creating opposite price movements in bond markets. The currency component adds another dimension entirely. A weaker dollar has been a major driver of international bond outperformance in 2024. When you own foreign bonds and your home currency weakens, you benefit from both the bond returns and favorable currency translation, essentially getting paid twice for the same investment. This isn't a market for casual investors. Sophisticated institutions hire currency strategists, country economists, and sovereign risk analysts, much like emerging market equity managers, but focused on government creditworthiness, monetary policy cycles, and geopolitical stability rather than corporate fundamentals. Picture this scenario: the European Central Bank signals aggressive rate cuts while the Federal Reserve pauses. European bond prices rally, and if the euro strengthens against the dollar, US-based investors in European bonds benefit from both effects. Active international bond managers position for these macro divergences, often using currency hedging strategies to isolate bond returns from currency moves when appropriate. Let's examine what made 2024 exceptional for international government bond investors. The FTSE World Government Bond Index posted its strongest yen-based returns in years, driven primarily by yen weakness rather than local bond market strength. This highlights how currency movements can dominate total returns in international fixed income. China emerged as a standout performer, with Chinese government bonds delivering strong positive returns. as the People's Bank of China continued monetary easing while other major central banks remained restrictive. China's weighting in the World Government Bond Index exceeded 10% for the first time, surpassing Japan to become the second largest market after the United States. Emerging market local currency bonds delivered exceptional performance, with the JP Morgan GBI-EM Global Diversified Index returning 13.8% year-to-date through August 2024. This outperformance reflected both falling local interest rates and strengthening emerging market currencies against the dollar. However, not all international bonds performed well. German Bunds faced significant pressure from fiscal policy changes, with 10-year yields spiking over 40 basis points as the government announced increased spending plans. Japanese government bonds posted negative returns as the Bank of Japan ended its yield curve control policy and began normalizing rates. Who issues international government bonds and why does it matter? The spectrum ranges from AAA-rated sovereigns like Germany and Switzerland to emerging market issuers with varying credit ratings. Each issuer faces different economic challenges, fiscal constraints, and monetary policy objectives. Developed market governments typically issue bonds to finance budget deficits and refinance maturing debt. These bonds serve as benchmarks for their respective markets and often trade with minimal credit risk premiums. The European Union's joint bond issuance program, launched during the pandemic, created a new safe asset for European investors seeking alternatives to German Bunds. Emerging market governments face different dynamics. Many issue both local currency and hard currency bonds, creating dual funding channels with distinct investor bases. Local currency bonds appeal to foreign investors seeking yield and currency exposure, while hard currency bonds attract crossover investors from developed market credit. The risk-return mathematics vary dramatically across regions and currencies. Historical data shows that currency exposure can either enhance or detract significantly from bond returns depending on starting valuations and economic cycles. German bonds have provided diversification benefits during equity market stress, while emerging market bonds have offered higher yields at the cost of greater volatility. Credit risk also varies significantly. While developed market government bonds rarely default, emerging market sovereigns face periodic debt crises that can result in restructuring or outright default. The yield spread between emerging market bonds and US Treasuries reflects this additional risk, currently trading around 400 to 500 basis points for the aggregate index. Currency hedging adds another layer of complexity. Investors can choose to hedge currency exposure back to their home currency, isolating the bond return component. Hedging costs depend on interest rate differentials. When foreign rates are lower than domestic rates, hedging can be expensive and reduce total returns. International government bond markets serve multiple functions beyond investment returns. They provide governments with diverse funding sources, reducing dependence on any single investor base or currency. For global investors, they offer exposure to different monetary policy cycles, economic growth patterns, and inflation dynamics. The infrastructure supporting international bond markets continues evolving. Electronic trading platforms have improved price discovery and reduced transaction costs. Central bank digital currencies may eventually create new forms of sovereign debt. Climate-linked bonds allow governments to tie borrowing costs to environmental targets. Looking forward, several trends will shape international government bond markets. Rising geopolitical tensions may increase demand for safe haven assets while creating volatility in emerging markets. Climate change will increasingly influence sovereign credit ratings as physical and transition risks affect government finances. Demographic trends will also play a role. Aging populations in developed markets may increase government healthcare and pension costs, potentially pressuring credit ratings. Younger populations in emerging markets may support stronger growth but require infrastructure investment. The international government bond market exemplifies global capital allocation at its finest. efficiently channeling savings across borders to finance government operations and investment. When you buy foreign government bonds, you're participating in the global financial system while potentially benefiting from economic and monetary policy divergences that domestic bonds cannot capture. These bonds also serve as leading indicators of global risk sentiment and capital flows. When international bond spreads widen, it often signals concerns about global growth or financial stability. Conversely, tightening spreads suggest improving economic conditions and risk appetite. To wrap up, international government bonds transform sovereign financing needs into globally tradable opportunities, rewarding those willing to navigate currency risk and analyze foreign economic conditions for potentially superior diversification and return benefits that purely domestic fixed income portfolios cannot provide. They showcase how global financial markets create opportunities from the natural divergences in monetary policy, economic cycles, and currency valuations across countries. The next time you hear about central bank policy changes in Europe, Asia, or emerging markets, remember they're creating investment opportunities that extend far beyond those regions' equity markets. Every international government bond purchase represents a bet on that country's economic prospects and a chance to benefit from the global nature of modern finance. What do you think? Would you consider adding international government bonds to your investment portfolio? Let us know in the comments. And if you enjoyed this deep dive, give us a thumbs up, subscribe, and hit that bell icon. We've got plenty more content on global fixed income strategies, currency analysis, and international investing. Thanks for watching, and until next time, stay informed and stay globally diversified.